Welcome to the Daily Update Podcast, where I'll go over the action in the market for Monday, November 10th, and we'll see how things look for Tuesday, November 11th. The S&P 500 closed up 1.54%, near the 6830 level, just shy of its intraday high. The index gapped higher at the open, briefly dipped below the R2 pivot at 6795, then reclaimed that level and held firm through the close. A key technical development: the S&P 500 has now recaptured its 20-period simple and exponential moving averages and remains positive across all time frames. The index is yet again over 10% above its 200-day moving average, reinforcing a bullish structure on one hand, but also suggesting overextension on the other. Volume, however, was below average, a modest concern on an otherwise strong up day. Some of this may be attributed to pre-holiday positioning ahead of Veterans Day. The market tone was supported by growing optimism over a potential government shutdown resolution. On Sunday, the Senate passed a key procedural vote. While no final deal has been confirmed, the markets appear to be pricing in relief, amid reports of threatened canceled flights due to air traffic controllers not coming to work, which have intensified the political pressure. Looking at sector and index highlights, mega cap growth led the charge, up 2.3% on the day, with semiconductors surging 4.4%. Nvidia, Google, and both Amazon and Tesla had strong advances. Value stocks lagged, while small caps, measured by the S&P 600, gained 0.95%. The Russell 2000 small cap index recaptured its 50-day moving average, but remains mostly range-bound. In Monday's session, money rotated out of bonds and utilities and into risk assets. Looking at the technical and sentiment indicators, gamma exposure has switched back to green and is rising, with 6,800 now acting as near-term support. The VIX is below 20, reflecting reduced fear, and the daily fear and greed index sits at 34, climbing from being extreme negative under 25. The longer-term sentiment gauge is still quite high at 70 and suggests longer-term optimism. Breadth did improve. For both the S&P and NYSE, the McClellan oscillators have now gone positive, and new highs did expand. All three smart money indicators based on the S&P 500 have turned positive. One note of caution: the Hindenburg omen triggered yet another spike on Friday. A series of such signals warrants elevated vigilance. The ADX now confirms that we're still not trending on either the short or intermediate term timeframes. Trend strength remains negative despite price gains. Looking at the macro environment, the 10-year Treasury yield rose 2 basis points to 4.11%. The US dollar edged slightly higher, and we're watching for a potential break above the 100 level for the US dollar index. Oil has re-entered the low 60s, and cryptocurrencies continue to see outflows. No major economic data was released on Monday. On Tuesday, the only scheduled report is the NFIB Small Business Optimism Index. Later in the week, key releases include CPI, PPI, and retail sales, as well as employment numbers revisions. This all remains delayed due to the ongoing shutdown, creating a near-term data vacuum. Looking ahead to Tuesday, November 11th. Historically, November 11th has been weak for the S&P with a win rate of just 29%. However, broader November seasonality and post-election years remain constructive going into the end of the year. The U.S. bond market will be closed in observance of Veterans Day on Tuesday. This could produce lower volume and potential choppiness. It's also best to be watching for any breaking news concerning the government shutdown. Bullish follow-through is possible, but is needed if the momentum is to continue to build positive. But low volume and negative trend strength suggests caution. In conclusion, the S&P 500 has flipped short-term positive based on moving averages being recaptured and government shutdown optimism. But momentum remains subdued, volume was below average, and Hindenburg omen signals do flash caution. Thank you very much, and I will talk to you in the next podcast.